Hello, guys. So you are welcome to this session. And in this session, we will be looking at lease or buy decisions using discounted cash flow. Actually, in the strategic case study exam, lease or buy decisions take two forms. Okay. We have the first type, which is the normal financing decision, where we use discounted cash flow. And that is what we'll be looking at today. Okay. And then the second type is where we use the financial statement approach. Okay. Now, with the FS approach or the financial statement approach, we will do it when we get to financing. So what happens here is that with the financial statement approach, they'll give you a lease or buy decision, and you are going to look at the impact of that financing option on the financial statement. And after that, you will tell us how it impacts your ROCE, possibly how it impacts your earnings per share, and maybe your gearing and other ratios. Okay, so for instance, if I go with leasing, there'll be a finance cost. Now, this finance cost is an expense. And once it's an expense, it reduces your profit. Reducing your profit means that your ROCE is going to go down. Your earnings per share will go down. Possibly your gearing will come up. Okay, that kind of impact. This is another area that they can bring lease, borrow, or buy decisions. But today, our focus is on the discounted cash flow approach. So when it comes to discounted cash flow approach, there are some things that you need to know. First of all is the discount factor. Okay. The discount factor or the discount rate, let me just say the discount rate that you are going to use. Mostly when it comes to lease or buy, the discount rate that you should use is the post-tax cost of borrowing. Okay, post-tax cost of borrowing, because you are literally borrowing to buy an asset or leasing the asset. Okay, and to get post-tax, to always get post-tax of something, you just need to take the pre-tax, okay, and multiply by 1 minus the tax rate. Most questions will be silent. So it depends on the assumption you use, but mostly you can assume that the question, if it is quiet, you assume that what they've given you is, in terms of case study, you can assume is the post-tax and use it, okay? Then we come to the cash flows. So under each option, you have some specific cash flows, right? You have some specific cash flows. So the first one is when you are buying, okay? So a buy option. So when you decide to buy the asset instead of what? Lease. So buying means you are borrowing to buy. So you borrow to buy. And once you borrow to buy, first of all, the asset becomes yours. So the first cash flow is the initial investment, okay? So the initial capital outlay that you spend, okay, the initial capital outlay that you spend. And the second one is that, okay, at the end of the period, you would have sold off the asset. Okay, that is the end of the life of the asset. You would have sold the asset or it would be worth scrap. So the scrap value is another cash flow, or the trade-in value, how much you have to get if you were to replace the asset in some number of years' time. Okay. Then sometimes the question may tell you you may have some maintenance costs, okay, maintenance or running costs if there's any. It is rare, but mostly remember that you may have this. Then because you are using the asset, you may get capital allowance. And because you are getting capital allowances, you are going to save taxes. Okay, so you have tax savings on capital allowance. And the whole idea is this, that, anytime you have an expense, which is allowable for tax purposes, it is a deduction. So it reduces your tax. Okay. Since it reduces profit, it reduces your tax. So you save taxes. So you either pay tax or you save tax, and all is at the tax rate. I pay tax of 25%, or I pay tax at 25% in Ghana. The same way, if an expense reduces my profit, it means I'm also saving tax at 25%. So always the tax savings is that particular expense by the tax rate. Remember this, okay? The same way, if interest is considered allowable deduction, we also have tax savings on interest, okay? So usually at case study level, this is what you should be expecting. That means get the interest expense and multiply by the tax rate, okay? So remember this. Okay, now that is the buy option. Let's try the lease option. Okay, so mostly the lease option here is a lease contract under IFRS 16. Okay, usually this is mostly like, if you know, it's like a finance lease, a long-term lease. Okay, for short-term leases, there's another approach. That one, you actually pay rent expenses. It's only the rent expense that becomes an allowable deduction. Okay, but for finance lease, that's the type they'll be giving you in the exam. But we may look at the two scenarios. So with this one, the same way, because you don't have initial capital outlay, you have the lease installment payment, right? So the lease payment is an expense you will be paying, okay? Apart from that, because here it's like a borrowing, the same way you would what? If there's any maintenance cost after you lease or some running costs, okay, some questions give you maintenance costs, running costs, cost savings, whatever it may be, it's rare, but I just put it there. Then maybe the same way you get capital allowance on the asset even if you lease, because per our Ghanaian tax law, for instance, you still get capital allowance, okay, if you lease an asset. So how do you get it? The asset must be added to the pool, okay? So you are still going to what? Get the capital allowance, which is the expense, and multiply by the tax rate. Okay, so that is it. Then from there, the same way, if interest is an allowable deduction, you also have tax savings on interest. You also have tax savings on interest, okay, which is just taking your interest expense and multiplying by the tax rate. Okay, so these are the cash flows that you should be expecting in a lease or buy decision. All right, so let's take this question. It is an extract from November 2021, question 3. Okay, so let's see. Plans for 2022 and beyond. The company is in the process of obtaining 5G license from the regulator NCA to launch the service in Ghana at the start of 2022. The license is expected to be granted for an initial period of 5 years, which is subject to renewal. So they are going for 5G equipment. Now, the company would have to make a major investment in 5G equipment, and the management is considering the best financing option. So the CEO, in the discharge of his investment and financing duties, has mandated the Chief Financial Officer, the CFO, to present a proposal on various financing options that can be used to procure the 5G equipment. Following the CFO's presentation to the CEO and other management team, the company has reduced the feasible financing options to 2: to take a loan from a bank for outright purchase, that's borrow to buy, or alternatively lease the 5G equipment. So it's between borrow to buy or leasing the equipment. So the details of the 5G equipment and other relevant information are presented below. So the equipment is expected to cost 150 million, which is today, and it will be realized for 30 million, which is the trading value, right? After the 5 years when it is purchased. And we intend to finance it via what? A loan of 20% per annum. Now, because we use the borrowing rate, I told you we use the post-tax cost of borrowing. Because we use the borrowing rate, some questions will give you the cost of capital in the question, and they will also give you what the borrowing rate, what you are going to borrow at. Make sure you use the borrowing rate to discount to do the lease or buy, because you are financing. You use the financing rate. Don't go and use the cost of capital of the company. You use the financing rate. So the annual repayment will be done at the end of each year, meaning it is in arrears. It can also be in advance. Now, alternatively, the company could lease the asset, and a leasing company will lease the asset for 49.6 million per annum in arrears for 5 years. Okay, so it means that for 5 years, we'll be paying 49.6 as installment. And the company is entitled to capital allowance on the right of use asset. It tells us that we also get capital allowance for the lease asset. Okay. And it goes forward to tell us that interest payment under both options is allowable deduction under the laws of Ghana. So the company's weighted average cost of capital is 24%, and the company pays tax at 25% and obtains capital allowance at a cost on the cost at 25% on straight line. It can also be on reducing balance. So when we get there, I will teach you the various ways to actually get the capital allowance. So the first thing we need to do is that we need to test the option. So what option do we want to test first? Let's start with what? The buy option. Okay, so when I'm doing questions in exam, what I usually do is I lay out my cash flows. So I just say let, okay, I just say let, and then I bring one, the initial capital outlay, okay, so the initial investment that we need. They said the initial investment is what? Is 150 million. I am working in thousands. So on at the start of the question, you say all figures in thousands, right? Or in thousands of Ghana cedis. Okay, so I'm just going to put here 150,000 as my initial investment. And then I say what my scrap value or my trade-in value that was given at the top. We already read it, right? As 13 million, which becomes 13,000. Okay, now since you are dealing with the buying options, you are going to get all the details because they said one, we are going to get capital allowance at what? 25% on straight line, okay, at cost. Now, if we are doing straight line, on straight line, remember straight line depreciation, okay, can be calculated in three main ways. Remember, it's either one, we get a percentage on cost, which we have already been given, or two, you do cost minus what? Scrap value over the useful life. That is when the question is silent. What you can do for straight line, this is the common one, okay? This is a common type that usually you can have. Then the third one is where you take what? The carrying amount of the asset or the written down value over the remaining life. So if the written down value of the asset is given, you just divide by the remaining life of the asset. This is the type you normally do, or this is how you normally do it when you are given this type of question. Okay, so with that being said, we can get the capital allowance for this asset. And because capital allowance is an expense, okay, we are going to save tax. Any expense that you have, you will save tax on it so far as it's allowable. So per this question, we are saying that the capital allowance, let me call it CA, because you want to become a CA. So the capital allowance will be given as what? The percentage on cost. And it says what? It is given as 25% on the cost of the asset. So it means that here, capital allowance is 25% on the cost, which was 150,000. Okay. That means that if we work this out, we will have 0.25 by 150,000, which is 37,500 per year. Okay. So this is what we have. But then remember that because of this, we will save taxes. So we have tax savings on the capital allowance, which will always give us what? Our capital allowance or the expense times the tax rate, which I explained to you earlier. Okay. So that means that this will give us what? A capital allowance of 37,500 per year. Okay. By our tax rate of 25%. And that gives us the amount of taxes that will be saved each and every year. And that is 9,375 cedis per year. Okay, so that is it. But wait, what if this was reducing balance? What if it was on reducing balance basis? And this is where students are usually confused. So let's say it was reducing balance. What do we do? So reducing balance, we create the reducing balance schedule. Okay, so maybe we can decide to bring in the year, the assets, okay, then the tax saving. Okay, so it's up to you. There are various ways of presenting, but for me, this is more feasible. We save tax at 25%. Okay, so we start with year one. Okay, and we said, okay, at the start of year one, we literally bought the asset for, that's the cost of the asset. We literally had the cost of the asset for 150,000. No, so 150,000. Then we do capital allowance. Anywhere you see capital allowance, it's an expense. So we save taxes. So in that case, we take 25% of the 150,000, and that gives us 37,500. for the first year. But if it was straight line, we'll continue in this fashion, right? But we save taxes on this at 25%, and that will be the 9375 we had. But just for the first year, because reducing balance, we compute the capital allowance on the written down value. Okay. So now we have our 150,000 minus our 37,500, and that results in 112,500. Now, this 112,500, the same way I have capital allowance at 25%. So by 25%. And I told you anytime you see capital allowance, that gives us 28,125. Anytime you see capital allowance, it creates a tax saving. So 28,125, the same way, we'll save 25% tax as well. And that gives us 7,031. Okay, the same way we take this out. So 112,500 minus our 28,125, and that gives us 84,375 carried on to the next year. So the written down value for year 3 will be this. Because the asset will be sold in year 5, we are going to year 5 when the asset will be sold. So the same way I have carrying amount at 25%, and that gives us our 84,375 by 25%, and that gives us 21,094. This 21,094, the same way we are going to save taxes on capital allowance, which is 5,273. Okay, we take it out, we head to year 4. So in year 4, our written down value brought forward, it's going to be our 84,375 minus our 21,094, and that gives us 63,281. So the same way we have capital allowance at 25%, and that is that's 15. So 25%, that is 15,820. Now we save tax on this as well at 25%, and that is 3,955. So we come to year 5 where we have the written down value for year 5. Now 63,281 minus our 15,820, we end up with 47,461. But remember, at the end of year 5, the asset will be worth what? Its scrap value, its trading value, which was 13,000. We saw per the question. Okay. So this 13,000 we have per the question. Remember, it's like you had this in your books, but you sell it at 13,000. You have literally lost on the asset because it's worth 47, but you sell it at 30. You lost how much? That amount you lost is an extra capital allowance, which we call the balancing allowance. The same way, if this was more, then you have a taxable gain because you had a gain on the sale of the asset, which means you must tax it, right? Which results in additional tax. But because this is a loss, you have an additional expense. A loss is actually an expense in your P&L, remember. So it also results, because it reduces your profit, it results in an additional capital allowance. So what's the difference? So if I take out the 13,000, I end up with 34,461. Now this will also save us taxes at what? 25%, giving us 8,615. Okay, so with this one, when you go to your lease or buy option, in year 1, you bring this, that's the timing. In year 2, in year 3, in year 4, and in year 5, right? It depends on the timing. If the question told you tax was paid in arrears, then year 1 tax will be paid in year 2, year 2 being year 3, year 3 will be year 4, and year 5. Okay, just like that. So it will go to the 6th year, just like that. So this is how we do it. But when we are looking at straight line, like the question gave, we just take it straightforward, and every year we repeat the same 9375 because it's the same amount. Reducing balance is done this way. Okay. So now we've got the tax saving on the capital allowance. Now, the next thing we need is the tax savings on interest. You see how we are getting each of the cash flows. So with the tax savings on interest, what we actually need to do is that we need to get the installment payments. Okay. First, get your installment payments. You know, when you are paying loans, the loans are usually in finance, they are blended. Blended loan is a loan where each installment you pay is made up of your principal and then your interest at the same time, right? Now, this installment that you are going to get are the future payments that you're getting, the future cash flows, okay, that you'll be paying for it to grow to become that 150,000. You get it? So these are like the annual payments. And this annual payment, remember that if you are paying an amount every year, constant amount, it is actually an annuity, right? Okay. So what you are saying is that, okay, the 150,000 asset that you have is equal to what? Some annual payments, okay, annual installments at some annuity factor, okay? Because this is the present value. So this 150,000 was some annual payments that were discounted at some discount factor. Okay, that's the PV. So since we are finding the present value of an annuity, what do we need to do? We are actually finding the annual payment. Let's call this AP. Okay, that's what we want. So in that case, we can say that therefore, how many years we were discounted? We said it was 20% per the question. Sorry, I didn't mention it, but this was what I showed you, right? So that means the post tax cost of debt we are supposed to use is the 20%. So how then do I get what the annual payments? So literally, if 150,000 is equal to annual payments times the annuity factor, then what do I need? It means that if I want my annual payment, I must change the subject, right? My annual payment, I must divide both sides by AF, will become this 150,000 divided by the annuity factor, which was the cost of the asset, right? Divided by the annuity factor. So how then do I get this? I need to get the annuity factor at what? 20% for 5 years. Okay. And we know the annuity formula is 1 minus 1 plus R raised to the power n, negative n, sorry, all over n, right? That is the annuity factor. So if I put this in my working, 1 minus 1.2 raised to the power minus 5 all over 0.2, I should get the annuity factor. So putting it into my calculator, minus 5 or divided by 0.2, I end up with 2.991 as my annuity factor. Now that I have that, I can equally get my annual payment, which is my annual installment, right? Okay, so now I know that my annual payment will give me what? We already took the cost, you remember? So we already took the costs and divided by the annuity factor. So cost over the annuity factor. And the cost of the asset was literally 150,000. We just divide by the annuity factor of 2.991. And that gives us 150,000 divided by 2.991. And that gives us our annual payment. So our annual payment is 5150 per year. Okay, so every year, this is what we will be incurring as our annual payment. So now that we know that this one is made up of interest and principal at the same time, I need to really get the interest that is on this, right? Through the amortization schedule. So what you can do is that you can easily get your amortization schedule. And the purpose of this is to get the interest because you need to know the tax saved on the interest expense, right? To get the interest expense. So you need to work this at least 2 or 3 times to get used to it. So the amortization schedule, we need the opening balance. So my opening balance, okay? Or you can just say balance brought forward. Okay, so opening balance. Then once you get your opening balance, you add your what? Interest, your implicit interest, and the interest here was at 20%. Then you less what? Your installment payments. Okay, so the installment payment is the cash payment, and that gives you your closing balance. Okay, please remember this. So once we have this, the first year, we know that, okay, the amount of the asset, which is the present value, was worth 150,000. Then interest is supposed to grow on it at 20%. So if I take my 150,000 and grow interest at 20%, that is literally the bank, the loan you took from the bank, right? That is 30,000. Then I told you every year our interest is 50, our installment is 50, 150. So if I take my 150,000 plus the 30,000 minus our 50, 150, I get 129,850. Okay. So in year two, I take the same 129,850 and add 20% interest on that. And that gives me 29,970. I take my installment out again, 5150. Have 129,850 plus 29,970 minus 50,150. I end up with 109,670. It's supposed to be 25,970, not 29. 25,970. 105,670. Okay. So in year three, we bring our 105,670. We apply 20% on it again, and that gives us 21,134. We take out our 50, 150 out again. So we have 105,670 plus 21,134 minus 50,150. We end up with 76,654. So we go to year four, we bring our 76,654. The same way we apply 20%, and that gives us 15,331. We take out our 50, 150 out again, and we have 76,654 plus 15,331 minus 50,150. And that gives us 41,835. Then I come to my last year. In my last year, I know that at the end of the year, it should be worth 0 because I would have finished paying. So I know this is my 41,835, right? Usually you can calculate the interest, but what I do is that I bring my last installment here, and then the balancing figure should give me my interest. That's how I usually do it, right? To get the actual interest. So if I take the 41,835, because of our rounding offs, we'll have some small figure here, add it to the interest. So 41,835 minus our 5150, I should get the interest, which was what? The 8,315. Okay. So now that I have this, I've had the interest expense for each year. I need the tax savings on interest because that's the reason why we are doing this. So the tax savings on the interest expense, and we know that tax saving from the start is always the expense in question times the tax rate. Okay, so we have literally done this already. So what then do we get? So we take our year, we take the interest expense, and then we get our tax savings. Okay, then we get our tax savings. So in that case, in year one, our interest was 30,000, and tax will always be saved at the tax rate. It's either you are paying tax or you are saving tax. So we have 30,000 and we are saving tax at 25%. That means our tax saving will be 7,500 in the first year. We go to the second year, our interest was 25,970. So 25,970. We save tax at 25% again, and that gives us 6,493. So 6,493. Go to year three. Our interest was 21134. We saved tax at 25% again. So 21134. We save tax at 25% again. And that is 5284. 5284. Okay, we go to the next year, 15331. We save tax at 25%, 15331. Save tax at 25% again. And that gives us 3833. 3833. Then we go forward to the last year where our interest was 8,315. So we save tax at 25% again, 8315 at 25% again. And that gives us 2079. So these are the tax savings on interest. So now that we've been able to generate all our cash flows from the initial investment to the scrap to the tax savings on capital allowance and the tax saving on interest, what we need to do is establish our cash flow schedule. So first, let's get our net cash flows, which we'll use for our MPV under the what? Under the buy option or the borrow to buy option. Okay. So under the buy option, this is what we are going to get. But remember, all figures we said were in thousands of Ghana cedis. Since it's 5 years, we start with our year 0, year 1, year 2, year 3, year 4, and year 5. Okay, so I first start with my initial outlay or my initial investment, which is done in year 0. We know it was 150,000. Okay, 150,000. So because we are doing MPV, what you can do is that because the costs are mostly more than the savings, you put the savings rather in bracket to reduce the cost. Okay, because they save cost savings, they save cost. So you rather put them in brackets. Or equally, since this is an outflow, you can put it in bracket and then your savings will be positive, which is how it looks like. So once I have this, I know that definitely during the period, I'll have some tax savings on capital allowance. And we know this was 9375 each year. So we have 9375, 9375, 9375, 9375, and 9375. Okay, then I have tax savings on my interest. Okay, so we have to go and pick it up. So we have 7,500. We have 6,493. We have 5,284. We have 3,833 and 2,079. Okay, so this is what we have. Then finally, we have our scrap value or our trade-in value, which was in the last year, which was 13,000. Okay, so this is what we have under the buy option. Seems the writing. So we have 150,000 as an outflow at the start of the period. Then the rest were all inflow. So we have 9375 plus 7500, and that gives us 16,875. Then you have 9375 plus 6493. That gives us 15,868. Then you have 9375 plus 5284. That gives us 14,659. Then you have 9375 plus 3833. You have 13208. 13208. Then you have 9375 plus 2079 plus 13,000. And that gives us 24,454. 24,454. So with this being said, we can get our discount factor at the post-tax cost of borrowing. And in the question, I gave you 20%. So we always know in year 0, the discount factor is 1. So we go to year 2. So we do 20%, right? You know how to discount already. So 1.2 raised to the power minus 1. That gives us 0.833. Go to the next year, it is 0.694. Go to the next year, 0.578. Go to the next year, 579 actually. 579. That's 0.482. Then the final year is 0.402. 0.402. So now we have our present values. Okay. So we multiply this will still be 150,000. Okay. We now need the 16,875 by 0.833. I end up with 14,057. Then I have 15,868. 15,868 going by 0.694. And that gives us 11,012. Then I have 14,659 going by 0.579. I end up with 8,488. 8,488. Then I have 13,208 going by 0.482. That gives us 6,366. 6,366. Then I have my 24,454 going by 0.402. I end up with 9831. 9831. Okay. So that is it. So now that I have all the present values, I can equally find my net present value under the lease option, under the buy option. Okay. So what is my MPV? That is the sum total of what we have. Negative 150,000 plus 14,057 plus 11,012 plus 8,488 plus 6,366 plus 9,831. And that gives us a negative 102,446. Okay, so this is our. Okay, so we actually forgot something because tax savings on capital allowance was 25%. It was for 4 years because we can only do 25% of 4. So 25, 25, 25 times 4 times, that gives us 100, right? So it means that the capital allowance was only given for 4 years. Okay, so this figure would have to change. That's my mistake, sorry. I just remembered that. So 25% means it's, if you want to see the useful life of an asset using the rates given, so you take 100 over the rate. So here it was 100, you divide by 25, it means the asset has 4 years per the tax laws. It means the tax man has only given you 4 years for capital allowance. So we can't do capital allowance for 5 years, okay? So this one will be nil. It's good we even did it so that you see the effect. So you need to be careful. So that means this figure should be 2079 by 13 plus 13,000, right? That's 15,079. 15,079. And the discount factor 0.482, 0.402. So we multiply 15,079 by 0.402. That gives us 6062. 6062. Okay, so now I think this would have to change. 6062 plus 6366 plus 8488 plus 11012 plus 14057 plus 150,000. No, minus 150,000 actually. Yes, so we have negative 104. Yeah, negative 104,015. Yeah. So this is what we ended up having as our MPV under the buy option. So that was one hell of a ride. Now we move to the lease option. Now we move to the lease option. So that was the buy option. Now we move to the lease option. Now when it comes to the lease option, The same way we get our cash flows. So the first thing is that we had the lease payment, okay, the lease installment payment. Remember, the installment payment we are paying every period is actually constant, okay? So in this case, these are annual payments, okay, which are annuities. We said that at the top. So here we were paying per the question, you can see 49.6 here. So that means we are paying 49,000. Since you are working in thousands, we are paying 49,600 per year. Okay. So if this is the lease installment, remember that under leasing, we don't know the cost of the asset. So with the first one, we knew the cost of the asset to be the present value of the payment, right? The installment that we had, and we multiplied this by what? The annuity factor. Okay. So here we know the installments, we know the annuity factor already, but we don't know the present value. That becomes the cost. Because capital allowance is computed on the cost of the asset. So what are our cash flows? The first one is the tax savings on our capital allowance. So tax savings on capital allowance, we know that first of all, we need to get the capital allowance, right? So our capital allowance is actually giving us what? Our cost, that's the cost of the asset, by the rate that was given, right? And this question, the rate was what? 25%. Okay, so it means that we need to find the cost of the asset. And how do you get cost? The cost will be equivalent to the present value, right? After discounting what? The the cash flows from the lease installment payment. So to get the cost, we already know that, right? The cost or the present value must be what? The present value of an annuity. So this is the annual payment or the annuity times the annuity factor. And because it's also for 5 years at what? At 20% annuity, we have already gotten it at the top. The annuity factor was 2.991. We have already done it. It's the same thing you use throughout, so you don't need to stress. So to get the cost of this asset under the lease option, all you have to do is to get your annual payment, which is 49,600 each year, and just multiply by the annuity factor of 2.991. That is all. That gives us the cost of the asset. So now I know that this is what 49,600 going by 2.991, and that is it. That gives me 148,354. Okay. Now this is the cost of the asset under the lease option. This is notional cost. It's not real. It's a notional cost. Okay. But you need it to compute your capital allowance. So now I know my capital allowance will be 25% of this cost of 148,354. Okay. So that is it. So in that case, what do we get? So we have 0.25 by 148,354. And that gives us 37,089, 37,089. Okay, so that is it. Good. All right. So now that we have our capital allowance, let's get our tax savings. So our tax savings on capital allowance, we've literally done almost all the work because it's straight line. We just take our tax, which is 25%, and multiply by what? 37,089. You remember I told you that tax is either you are paying or you are saving it at a tax rate. So once we do this at 25%, we end up with 9,272. So 9,272 per year. Okay. This was also per year. And that is how much we are saving. So that is it. Okay. But now we need one thing. We need tax savings on interest, right? Remember, interest was also an allowable deduction. So tax savings on interest, the same way, what we need to do, this is per year for 4 years. Remember this, because it's 25%. We can only have 4 25% in 100. So tax saving on interest, what we need is that we already know our installment payments. We know the cost to use, that's the PV. So what we need is what? Our amortization schedule. That's what will give us our interest. Don't forget, you need to create two amortization schedules for this kind of question. And what do? You start with your, now I'll just say balance brought forward in the year. Let me put it somewhere here. Balance brought forward. Then we add the interest. You guys remember, we take out our installment, which is the lease payment in this case. Then we get our closing balance, which is the balance carried forward. Okay, so with that being said, it means that in year one, we had the cost of the asset, which was 148354. So in that case, we carry the 148354 and then we apply interest. Interest was 20% in the question. So 148354 multiplied by 20%, and that gives us 29670 or 71. So 29671. We take out our installment of the 49,600. Our installment of 49,600. Okay, and that gives us our closing balance. So 148354 plus 29671 minus 49,600. And that gives us 128,425. So the next year we take our 128,425. We add interest at 20% again. 128,425. We add interest at 20% again. That's 25,685. So 25,685. Then we take out our installment of 49,600 again. We end up with 128,425 minus 49,600 plus 25,685. We end up with 104,510. So in the next year, we take our 104,510. We multiply by 20% for the interest. End up with 20,902. Then we take out our 49,600. We have 104,510 plus 20,902 minus 49,600. That's 75,812. So in year four, we take our 75,812. We apply 20%. That's 15,162. We take out our 49,600 from it, and we end up with what? 75,812 plus 15,162 minus 49,600, and that gives us 41,374. Okay, so we go to the last year, which I know everything will be worth 0. So I have my 41,374. I know this is what 49,600. So the balancing figure becomes the interest. Here, I always use this as my balancing figure, but you can still work it. It will be somewhere closer. So 41,374 minus our 49,600. That gives us a 8,226. Okay. So now that we have this, we get our tax savings on the interest. Tax saving on the interest. So I just need interest for each year. So my year, my interest expense, then the tax savings at the tax rate. You are either paying tax or you are saving tax at what? At 25%. That's what it means. So year one interest was 29,671. Year two was 25,685. Year three was 29,002. Year four was 15,162. Okay, so we have our 29,671 by 25%. That gives us 7,417. So 7,418. Okay, we have 25,685 by 0.25. We have 6,421. Then you have 29,002 by 0.25. That gives us 5,226. Then you have 15162 by 0.25. That gives us 3791. 3791. So now that we have everything set up, our cash flows and everything, we now go and set up our NPV pro forma. So we need our net cash flows for our NPV. Also, NPV for the lease option. Okay. It's not compulsory to write this. You can just write lease option at the top. Okay, so the lease option, what do we need? Remember, all figures were in thousands of Ghana cedis. Okay, so we start with our year 0, year 1, year 2, year 3, year 4, and year 5, right? So I start with what? My lease payments, okay? That's the only thing we are actually paying in the lease. We're paying 49,600 every year. So this one is actually an annuity, a 49,600, 49,600, and 49,600, okay? So that was our lease payment. Then we have our tax savings on capital allowance. So tax savings on capital allowance, we had 9,272 per year. So that was 9,272 per year. But remember that it's only at 25%, so 4 years. Okay. Always check this out so that you don't make mistake like we did before. So we have 9,272, 9,272, 9,272, and 9,272. Okay. But these ones were all outflows, 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 and outflows. Okay, so last year is nil. Then we have tax savings on our interest. Okay. Tax saving on our interest. And that is our 74186421 5226 and 3. Oh, I forgot the year 5. The year 5 was actually 8226 at 25%. So 8226 at 25%, and that is 2057. 2057. Yeah. So in that case, you have year 4 was 3791. 3791 and then 2057. Okay. So once we are done, we actually come and get what the net cash flows. So you have 49,600, 49,600 to 9272 plus 7418. Okay, that is 32,910 negative. Okay. We have negative 49,600, 9272 plus 6421. We end up with negative 33,907. So we have negative 49,600 again, plus 9272 plus 5226. And that gives us negative 35,102. And you have negative 49,600 plus 9272 plus 3791. You end up with 36,537. Okay. Then you have 2057, 49,600. So that gives us negative 47, negative 47,543. Okay. So that is it. So we need our discount factors at 20%. You see, it's the same rate throughout. Don't forget post-tax cost of borrowing. So we get our discount factors from the top. So we can literally copy them. Last one was 402, yes, 402, yes, 0.4. 402. I copied the discount factors. Yeah, so now that we have our discount factors from year zero, so year zero, there's nothing there, it's literally nil. So let's discount our cash flows to get our present values. We have 32,910 going by 0.833. That is 27,414. Then I have my 33,907 by 0.694. And that gives me my 23531. These are all outflows actually. Then I have my 35102 by 0.579. And that gives me 2324. 2324. Okay. Then I have 36537 by 0.482. And that gives me 17,611. Okay, then finally I have 42,543 by 0.402. That's 17,102. 17,102. Okay. So now that I have the PV, I can just add it up to get my MPV, which is 27,414 plus 23,531 plus 20,324 plus 17,611 plus 17,102, and that gives me 105,982. Okay. So let's summarize and see the lease option and the buy option and see which one is better. Okay. Which one has the lowest cost? One with the lowest cost. So with the buy option, and then we have the lease option. Okay, the lease option has a total of 105,9. The summary is also in thousands of Ghana cedis. 105,982. Then with the buy option, we have to go up there and go and check 104,015. 104,015. 104,015. When we compare the two, we have 1967, right? As the savings. Okay, so which option is better? The one with the lowest cost? They are in cost. Remember, they were all negative. The lowest cost is the buy option. So what's my decision? The company should consider borrowing to buy, borrowing to buy the 5G equipment, okay, the 5G equipment, because it results in a cost saving, okay? It results in a cost saving of 1,967,000. Not so. Then you consider other qualitative issues. Remember, when you are doing decision making, you consider qualitative issues. What are qualitative issues? One, interest rates might change. Okay. So reliability of the lender. Okay. Reliability of the lender, the cost of borrowing itself. Are you getting it? The cost of borrowing itself. You are doing an investment, right? What's the guarantee of changes in tax laws? Okay. Changes in tax laws. You know, once the tax laws change, it can affect the allowability of some expenses, the tax rate, and other things. And then what else can you talk about? So many things. The asset itself, inflation, okay, inflation, risk, opportunity cost. All these things are qualitative considerations that you have to consider. Okay, so even if they've not asked you, you can consider these things when you're doing your lease or buy decision, and then you get the full mark. So that brings us to the end of the session on lease or buy decision. In our next video, we will be looking at how to do foreign investment appraisal. Okay, foreign investment appraisal. And it is a very important topic in your syllabus.